Small shocks, big reaction. Is it an issue? We are joined by Chief Economist William de Wilde. Hello.
Hello.
William, we saw recently on the economic side some minor data statistics, but on the other side, a big volatility, a brutal reaction of the markets. What happened at the end of April?
Indeed, we saw a quite interesting experience. M3 data, German inflation. Normally, there are statistics which are not that important for markets. This time around, the reaction was pretty massive. It is explained by the fact that there was a positive surprise, meaning that the release of M3 money supply growth in Eurozone was higher than expected, and also the German inflation was higher than expected. Not massively, but at least above expectations. What happened is that bond yields moved up a lot. As a consequence, the euro strengthened quite significantly, and as a consequence, again, the stock market went down.
What explains, according to you, this brutal reaction of the markets?
Well, I think there are different factors at play. One is there was a surprise, and that's important. The inflation surprise, for instance, comes after a period where we have not seen any surprise at all. So that's the first element. The second element, which needs to be mentioned, is that there is a kind of an end-of-the-month phenomenon. It seems that the ECB had already completed its buying operations in the context of quantitative easing for the month, whilst at the same time there was a new auctions in a number of markets, so there was a kind of an imbalance between supply and demand. The third factor, in my view, is the most important one. That is that nerves of investors are stretched because they know that bond yields at present are at an abnormally low level and they cannot stay there. So what happens is that when there is some evidence, data releases, for instance, which goes into the direction of confirming that the yields are too low, the reaction can be very brutal, and that's exactly what we have seen.
Last question, William. Do you think this high volatility could impact the real economy at the end of the day?
That is indeed a concern that one has, is can there be a kind of a contagion effect on the real economy? A priori, I would say that the risk is very remote. Let's not forget that we are in a European recovery and that the data I was talking about are just a manifestation or a confirmation that indeed things are improving. This should provide confidence for households, for corporates to spend more, to invest more, etc. And you just have to accept that financial markets are a little bit more volatile. What could change the game, however, is that if there would be some major reaction on the equity market. However, it is important to keep in mind that we are still in a very favorable environment to underpin equity prices, the environment of very generous monetary policy, whilst at the same time an economic recovery boding well for the earnings outlook. And it also means that the risk of a significant correction in the equity market seems very low.
Thank you very much, William de Wilde. Next, for the chart of the month, we're joined by Philippe Darvisnet to talk about the secular stagnation. Stay tuned.